So in this second part of our security pricing, in the first part, we talked about what we're paying right now, our initial investment and purchasing a future value, a cash flow in the future. And what we pay determines our net income. Um, we basically decide on the net yield by paying whatever we're paying today. It, it's the same for stocks, it's the same for bonds, it's the same for every investment. Think of it like if you were to buy a real estate and you're going to have a rental income. If you know how much of a rent you're going to make, obviously you will try to buy the property as cheap as possible so that your net return on the rental income could be as high of a yield as possible. So what determines this yield is you by paying more or less. And we have several choices. So for instance, in this example, we could invest in US Treasuries and take no risk, and right around now, we would actually make about 2% a year. We could invest, I just pulled this up on Chase, JP Morgan Chase. We could invest in a CD, which has a deposit insurance, and on a 1-year CD, for about $100,000, we would earn 0.05%. It looks like the 9-month CDs are now paying 2.25%. If you look at 21-month CDs, they're paying 2.25%. And if you look at, say, 60 months, they're paying 1.55%. So, it kind of is quite interesting to me that I would be expected to invest my money into a CD where I would earn 1.55% when the U.S. Treasury on a 5-year bond has a yield of 1.85%, which is the U.S. Treasuries. So in any case, we have the choice of investing in a CD, investing in a U.S. Treasury, investing in a stock, investing in a preferred stock, investing in a real estate, keeping it a cash. And in the meantime, in the usual market language, risk on means that the money is invested in risk-bearing instruments, and risk off means that the money is invested in no risk-bearing investments such as cash or cash-like items. So in a risk-on environment, if we invested in a stock like Apple, then we're taking a risk on. And our expectation, obviously, is, yes, we know we're taking risk and we want to earn more. And from our previous example, for instance, with the current price of Apple, we expect to earn about 6.25%. So it really is a very simple choice. Are we going to invest in a stock? Are we going to invest in a bond? What type of bond? What type of maturity? And what are some of the risks that we are facing? Now, obviously, the risk that we're facing is how much we are paying for this. It could be that we are paying too much, simply because Apple's earnings may go down. What people believe Apple is going to earn may go down, and therefore people may start to pay more for this. There was a discussion of what's undervalued and what is overvalued. Now, it's a really tricky discussion because what is the true value? The true value of Apple is unfortunately unknown. I really wouldn't know what the true value of Apple should be. Your textbook talks about discounting free cash flow, several different multiples, which we will discuss it in other videos. However, what determines the true value is almost impossible to find. So what we have right now is the equilibrium of the market. What market supply and demand, or what market participants, the investors, trade every day and then create an equilibrium price, which is right now at $190.15. This is based on everybody's expectation and how truly they believe that this expectation is going to come true. So if we believe that this China trade war and Huawei problems will cause significant problems for Apple, then we are bearish on Apple, and therefore we won't be paying as much, and perhaps we're going to start to pay a little less, and which may drive the price down for Apple. If you believe that all of this is nonsense and Apple just simply is a great company and we keep paying more and more for this because we want to include Apple into our portfolio, then obviously price is going to go up. Now, could we be wrong? Obviously. So there really is no way to know whether the price that you're seeing right now is an undervalue or an overvalue. And if there was a way, then that would be the billion-dollar question, I guess. So then how do we make a determination? Well, it's primarily is all about the earnings per share, how much you're making and how much growth in earnings per share you're expected to earn, and therefore how much you as an investor is willing to pay for that earnings per share. There are different factors that affects the earnings per share. So for instance, if you look at the economic events for a certain week, for instance, last week, Friday, we had unemployment rate. Now, this was a very significant number. Now, let's try to make some sense as how this would affect the stock prices. It's actually not that complicated. So the unemployment rate came about approximately the same. However, what came to be a major problem is the created payrolls. The expectation was about 180,000. It turns out that it was only 75,000, and therefore it was a huge disappointment. So economy is doing bad. Now, just on that single data. So economy is doing bad. Okay. Well, again, simply on that data. If the economy is doing bad, it really is bad for Apple and for any other company, because if the economy is doing bad, people won't be able to buy as much Apple products. They won't be able to spend as much on Apple services, and therefore earnings per share for Apple may go down. Okay? If earnings per share may go down, then why would I, as an investor, pay $190 for an earnings that I expect to go down? So if the news is bad, and that news is going to change my expectation about the earnings per share towards believing that it's going to go down, then I would pay less for this. Now, let's do a simple math. Let's say that we are expecting the earnings per share to go down to, say, based on this one single data, let's say that we expect this to go down to $10 per share. And based on the same 6.25%, this would be $160. So if I believe that earnings per share is going to go down because the economy is doing bad, and my expectation is that earnings per share for Apple is going to go down to $10, then based on what I perceived to be a fair value for Apple at 6.25%, I should be paying $160 for Apple. And I will reflect this in the price. I will not be willing to pay anything more than $160 for Apple, expecting that the earnings per share is going to be $10. Now, the situation was a little bit different for the payroll numbers on the 7th of June. The expectation was that the Fed came out a few days before this news, and they said that the economy is not growing as fast, and therefore they may consider interest rate cuts. Now, interest rate cuts simply means that these yields on the treasuries may even go down further. And if the yield on the bonds go down, that means the bond prices will go up. So let's take a look. If our net yield, say $98 would be 2%, so 98.50 would be 98.25, 98.20, something like this. So 98.15, yeah. So if the Fed believes that interest rates may be cut down, then this may actually become 1 point, say, 50%, right? In which case, based on the future value of $100, so based on the $100 future value, the current price will be the future value divided by 1 plus the net return, and that's going to be 98.52. So by paying 98.52, we will earn a net yield of 150. So our net income will be 148. So now, if the Treasury were to reduce or cut the yields by about 1/4% or perhaps a bit more, then the price of this Treasury bond will go up and the yield will go down. Now, based on a similar product, a competing product, then we would expect every other instrument in the entire market to reflect this drop. So if the drop is about 1/4% or perhaps a little bit more, so for Apple, for instance, the expectation then should be that it actually earns about 6%. And based on 11.89 cents of an income, what we would expect the price is simply taking the net income and divide it by the 6%, and we would pay $198.17. So notice the Treasury said that they may be reducing the interest rates, which leads the prices of treasuries to increase so that the yield would decrease. This would be reflected across the board on all investable securities, which means that if we were expecting to make 6.25% on Apple, or whatever what we were earning on whatever security we're investing, everything would be reduced, or the returns, the net yield on every investment would be reduced by 1/4%. So by that, Apple's earnings expectation, net yield expectation would go from 6.25% down to 6%, which at 11.89% expected earnings per share, the price then has to be 198.17, which means an expectation of reduced yields, treasury yields, will lead the market to go up. I wonder if that's correct. Now notice, this came on June the 7th and early in the morning. This is Eastern Standard Time at 8:30, and remember, New York starts at 9:30. So let's take a look. So on Yahoo Finance, notice that on Friday, the market actually went up about 1%. So 1% increase because the economy is doing bad. Well, it is actually true that the economy is doing bad, but it led to the expectation that the Fed may cut interest rates about 1/4%, perhaps 0.5%, which means that the yields across the board would be expected to drop about 1/4 or 0.5%, which means that the prices of these stocks would have to be increased to match that yield. Now, this is what your book refers to as top-down approach. The market has many variables that may lead to a change in expectation of earnings, or expectations of or expectations on yields, or expectations on earnings per share. Now, let's take a look at a couple more. So let's see, on Monday, for instance, we don't really have much. PPI. So if we have a inflation expectation, now think about it. How would that affect? Well, first of all, if there is expectation of an inflation, then there has to be an expectation of Fed to basically increase the interest rates. However, given the political situation with the president, they may be reluctant to do that. Economy is not growing as much, so they may actually let the inflation go a little bit. And therefore, all in all, if all of that kept constant, with higher inflation means we need to earn more. So think of it like this. If all else equals, if there's inflation of, say, an additional 0.5%, well, on Apple, then we need to be earning 6.75% just to make up for inflation. So I'm not even talking about the alternative side arguments of political discussions or economic discussions subsequent to the announcement of inflation. I'm just talking about the actual effect of inflation. So the inflation is, if revealed to be about 0.5% higher than expected, then we would show that new inflation number in our expected yield, which would make it to be 6.25% up to 6.75%. So if we want to earn 6.75%, which is about 0.5% more than our previous expectations, based on 11.89, then we should be paying 176. So inflation is bad for the market, which means that in order to earn more, we need to be paying less. Which, if the PPI comes out to be, or the CPI comes out to be too high. Now, notice, the expectation is already priced in. This is an equilibrium price. If everything comes out as expected, nothing would change. Again, this is an equilibrium price. All expectations are priced in. However, if it turns out that the inflation is 0.5% more than we expected, all else being constant, we're not talking about the president, we're not talking about the trade war, we're not talking about anything else, just on the isolated inflation, then you are looking at a price that is lower than the current value. Simply because by paying less, we're going to earn more on this investment, and therefore it will justify taking this additional risk in light of unexpectedly higher inflation. Now, let's look at another variable. Again, this is what your book refers to as top-down approach. So there's CPI on Wednesday. There's initial claims, export prices, import prices. So export-import balance. Let's say the balance of payments, if we have balance of payments that shows that the trade war is not working as well as we thought, and that our balance of payments is getting out of hand. Now, in which case we would expect the economy is not doing as well and we're going to borrow more, and in which case we would expect the yields to, in this current climate, the yields to increase, in which case it should have the same effect as the inflation. If the earnings are expected, or if the yields are expected to increase because of higher risk or because of worse economic conditions, then the prices of stocks should go down. However, if based on this new economic climate, the expectation of Fed having a rate cut, interest rate cut, is more, then you are looking at a stock price that's actually higher than before, simply because lower yields can be obtained simply by paying more for investable securities at this time. So let's take a look at some more. So retail sales, industrial production, capacity utilization, these are all signs of economic activity. Under normal circumstances, better economy means lower yields. Well, it depends. Currently, if the economy is good, Fed is not going to cut rates, and therefore the yields will go up, and therefore the only way the yields will go up is the prices go down. On the other hand, if under normal circumstances, if we didn't care about the Fed, then the problem is, well, it's not really a problem, because if we expect the economy to flourish, then the earnings per share is expected to increase. And if earnings per share is expected to increase, then we will be willing to pay more for the stocks. Therefore, because we expect this earnings per share to be higher, therefore our net income to be higher, and therefore we're willing to pay more for this. So good economy, higher earnings per share, higher net income, and we will be willing to pay more for this expectation of growth in earnings per share. Now, the consumer sentiment. Now, this is very important for a couple of reasons. And your book talks about this investor sentiment. The consumer sentiment and investor sentiment are two different aspects. Consumer sentiment plays directly into the EPS. So, for instance, in the case of Apple, we are looking for the earnings per share. And if the consumer sentiment is good, then consumers are willing to spend more, perhaps on everything across the board. And Apple products may be increasing in value, or consumers may spend more on Apple products and services, and therefore earnings per share is expected to increase. Now, if the consumer sentiment is negative, then we would expect consumers to save more instead of spending. And if people don't spend, then Apple or any other company cannot sell as much and cannot sell as much value or cannot sell services, and therefore it is bad for the earnings per share. So if we expect a good consumer sentiment and sentiment comes out really good, then simply we would expect an earnings per share to be better, and therefore this growth, we would pay for this. If the consumers are pessimistic and sentiment is negative, then we would expect more savings. More savings means more money. More money means lower yields. And furthermore, we would also expect earnings per share to go down, simply because if consumers save more and not spend enough, and then the sales and revenues will go down, and therefore earnings per share would go down. Now, just as a side note, if you look at the income statement, top-down approach, your total revenue is your sales, and then the cost of goods sold, and then the gross profit. So if your revenue increases, everything from top to bottom will increase for most companies, and then your bottom line is your net income and then income per share, or earnings per share. Now, based on this, consumer sentiment will usually lead to an expectation of higher sales and therefore higher earnings per share. And if it is negative, then lower revenue and therefore lower income and therefore lower earnings per share. Now, investor sentiment, on the other hand, which we don't have a data for this, is different. Investor sentiment simply means that we are willing to pay a premium for any and all securities. It's just, if we have a positive expectation of anything and everything, and we are on a risk-on appetite, then we'll pay more simply because we have an appetite for it. It's just, we feel like taking on higher risk, we feel like making more return, we feel like making more income, and therefore we invest more. But if you're pessimistic as an investor, now notice, this is different than consumer sentiment. I'm now talking about investor sentiment. If investment sentiment is positive, then we are a lot more risk on attitude, and therefore we are a lot prone to trying to make more return, trying to make more income, and therefore we'll invest more. And more than likely, we'll pay more premium. And the best way of measuring that premium is simply the PE ratio or the EP ratio, which in our example will simply accept a lower yield. So if we accept a 6% yield, then our price will simply pay more. So the PE is how much you're willing to pay for each dollar of earnings. And higher the PE, higher the premium. Meaning that if a PE for Apple is right now 16, and all of a sudden we are willing to pay 30 of a price for the same dollar of earnings, then simply our net earnings will be about 3.33%. Now, if we have a pessimistic investor sentiment, then we will be discounting. We won't pay as much premium. In fact, we will be discounting, and therefore the prices will suffer. Now, there are a couple of ways to measure investor sentiment, but the easiest one that finds more acceptance in the literature is the price of ETFs. Now, this is a very efficient ETF that I pulled up, the SPY. This is the S&P 500, which currently sells at $287.65. It's Sunday, so this was the Friday's closing. Then you look at the net asset value, and you see 287.66. There's a penny difference. Again, this is a very efficient ETF, and that probably is not the best example, but just as an example for the time being, currently the market is actually trading this as the ETF at 65 cents, even though it is actually valued at 66, meaning that there's a 1 penny of a discount to true value of this ETF. And that usually means or interpreted as a discount or a pessimistic investor sentiment. Let's try to find some other ETF that may have a different. So this one, for instance, is a good example. So BND is a ETF for the bond market, and currently it's actually trading at equilibrium price of $82.34, whereas the net asset value is $82.27, which means that there is a 7-cent premium on this bond ETF that shows that the investor sentiment for bonds is quite positive. So the premium that people are willing to pay in this case is 7 cents more than the true net asset value per share for this specific ETF, which is a sign of positive sentiment. Now, let's look at some others. Again, these are all examples of top-down approach. So wholesale inventories, if companies can't sell, that actually shows that revenues may go down, lower EPS, lower economic activity, and it would actually reflect on the prices and so on and so forth. So our GDP, again, if we expect a good GDP, a good increase in growth in GDP, then we would expect higher revenue and higher earnings per share, and we will be willing to pay more for this stock. So there's nothing bad about a good economy. Although, again, nowadays, because we're basically feeding off of the Fed, and the Fed said that they would actually reduce interest rates if the economy is not doing all that well. Well, then the good economy is actually bad for the markets, because then we wouldn't expect the Fed to decrease the interest rate, which is actually bad for the stocks. So currently, because of Fed, the market expectations about the good economy is reversed. So this concludes our second part, and that's about it. Thank you.